Hey everyone, it is Jay Soloff from Investors Alley, and this is our options trade of the week. So I am at marketchameleon.com. I decided today to look at Pfizer, obviously a big name this year. Normally, Pfizer, of course, huge pharmaceutical company, but even more so this year, it's been in the news because it's the first one to get the COVID-19 vaccine to the market. It's already being used extensively in the US and elsewhere. You can see it's had a heck of a year for a company that doesn't generally move a whole lot. As high as 43, it's up to 37 right now, but it was as low as 28. So obviously, for a stock that doesn't generally move that much, it's been quite active. It's up to about 208 billion market cap. So I thought I would look at the options and see, because obviously we're in the early stages of the vaccine rolling out. Potentially still some upside with this stock because there's a lot more vaccines that are going to get purchased by the government and other governments potentially. So decent source of revenue. It's not. Keep in mind, when you're as big as Pfizer, they have multiple products that are going to contribute to their bottom line. So one vaccine alone is not going to make or break the company, although it's certainly going to be beneficial. So when I looked at this, I saw a couple big trades today tied to stock. So this one here is on its own would be a covered call. So in other words, someone bought 200,000 shares of Pfizer and sold 2,000 calls against it. So with the stock at about 37.5, they sold the 40 calls. So that gives it a little bit of upside, $2.50, while also making this 34 cents through January 15th, January expiration. Now, the company does have a decent dividend, but this would add an additional amount, about 1% of yield over the next month. So not a bad trade. If you were to emulate this every month, you would make 10-12% a year, plus an extra, for holding the stock, an extra 4%. So that would turn Pfizer, which is certainly a safe company these days, into a decent yielding product. So that's probably what's going on here. If you wanted to see how to do that, you can look here. You can see what I'm talking about with Pfizer. It had its low during the crash, been pretty volatile, but it has since pretty much taken off. And here, this is the announcement that the vaccine was coming out. And you can see from top to bottom a good year certainly, and it's come back down, but potentially could be coming back up at least as high as 40 if you look at this trade that was done on it. So here we'll go to a lot of different option chains because of this VTRS deal. So you can ignore those parts and just look at the basic expiration here for January 15th. And you can see the 40 calls have come down a little bit, but you could still sell them for 32. So still around 1% if you wanted to sell the 40. But if you wanted to do the whole transaction, it would look something like this, where you would do a covered stock, and for every 100 shares of stock that you're buying, you're selling a call. So that would give you a cost basis of about 37. Again, with the stock at about 37.35. So that's where your yield comes from. Is the difference between those two. Again, this also gives a cap up to 40, so this thing could climb up to 40 before it gets capped. So covered call trades, again, good for adding to yield. Safe trade, not a lot of risk involved. Not really any more risk. In fact, a little bit less risk than just buying the stock itself. So if you're interested in learning about covered calls, there's a link below this video for a free report you can get to help get started in covered call trading.